Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
I'm going to just want to send this one to John. John, considering that we have another crisis, do you see the yen as being the safest currency?
I actually think that gold becomes a de facto safe. I think that anytime you have a currency discussion, gold has to be a part of that mix. And I'm not sure that I would want to have to, some of the metrics which were in place for the yen from the last carry trade dynamic have been altered because it's no longer the choice funding currency of the carry trade like it was 3, 4, 5 years ago. We now have the dollar, which, because of up until recently, before this recent rate, even still in that regard, is still more of a desirable funding currency of the carry trade. And so I think it's more about having your exposure being long gold, being short euro, short British pound, short Swiss franc, even to some extent short Aussie, and some of those extra commodity currencies out there. Is a better way to play this impending doom. But more than that, I think because implied volatility levels are so low, and let's not get so caught up in the direction of where these are going, but what's going to happen to volatility. And if the scenarios that Fotis talks about set up well, then being long gamma, being long premium, being, setting yourself up to play both moves, because we all know from bear markets that happened in the last year and a half, the bear market rallies are just absolutely brutal. But they can be played if you're properly structured, and you can hold on to those moves if you have ISE options. And so, being long some gold calls, being long some euro puts, being in a euro put, being in a euro call spread, bearish or bullish, being in a, being long gold as well, I think is a better way and more pragmatic way to set yourself up.
What do you think of the Canadian dollar? I mean, we're right at par. And many are predicting that the Canadian's going to break par because I guess the oil, the tar sands, I guess that's where a lot of money is moving into. What do you guys think there?
I think the Canadian dollar is a tough market to trade. It's been very compressed. It's been one of the more range-less markets out there. It's shown little to no concern over a lot of the stuff that's been happening in Europe. It has rallied nicely against the U.S. dollar. I think if you look at the dollar index itself, the dollar index is in a nice pop, but the one component of it that the dollar's not rallying against is quite obviously the Canadian dollar. And as we sit and kind of linger around parity, it's more my style, Steve, to let a certain reconciliation take place, either watch USD CAD pop up to 102, 102.50 level, and maybe look to play it from there, or to let it break down. But otherwise, I think this has been one of the tougher currency crosses to trade, and as a result of that, as traders, we want to garden in amongst fruit and agriculture that's bearing nice harvest, and I don't think the USD CAD falls into that category.
The other interesting question I get often, John, so I'll actually pose this to both of you, is volatility is low relative to what? I mean, isn't it possible that we could see volatility at these levels for another 12, 24 months, especially back to Fotis' point that the Greek problem is solved at least for the next 12 or 18 months?
The market, that's a great question, and I'll offer some perspective first. And if you look back at the portfolio that I recommended, there's some long Vega components in there and short volatility components, but the market is very much an anticipatory mechanism. Okay, so let's say this crisis has been quote-unquote averted for the next 9 to 12 months, all right? Since when does the market ever act on what's happening today? The market, at least when it's in queue, is very much an anticipatory or proactive mechanism towards what's taking place out there. And so come summertime, all right, or over, May, June, July time frame, I think you build the portfolio I talked about, on a 3 to 6 month time horizon, with the relatively low implied vol levels in terms of what you're paying up, in terms of the potential geopolitical risk out there. Ultimately, we're all odds makers, Steve. All trying to put forth, stack as many variables as we can in our favor, okay, and I apologize, go from there. And to me, with what Fotis has talked about, with the way that I've laid this out in terms of building a portfolio constructive of currency classes and some commodity correlated and some currency correlated commodities as well, I think you put yourself, I believe I'm putting myself in a good position to succeed.
Well, that's all you can ask for. I'm sorry, Fotis, go ahead.
No, please. No, I just wanted to add that, remember, guys, that what happens right now, besides what happens on a day-to-day basis in the stock market, is that the whole system that was created after the Second World War is having problems. So I expect for the next months lots of volatility. We are going to have significant political events happening. And what John says, with this portfolio, you will be able, to fully exploit all these situations.
Well, that's interesting. So you think something might be happening in the summer?
I think I'm saying that international relations are changing. Remember, in the past, we used to have two superpowers. One was United States. The other was the Soviet Union. We see that the 60 years after the Cold War, after the Second World War, we had the Cold War. Now, this ended. And what happened? By ending the Cold War, suddenly Germany has a foreign policy. This happens for the first time after 60 years. What is going to happen in the future? We cannot say accurately right now, but we expect many interesting things developing. We have the rise of China, the rise of India. How are they going to affect the international setting? How are the alliances between nations going to develop? This is very important for the future, and I think we are in the middle of some changing with international relations and history.
Fotis, interesting question from Andrew, and his point is, at what level of unemployment does it just become unpalatable for Greece? I don't know where the unemployment is now. I guess that's my first question is, and at some point, wouldn't it be time that they have to change direction, even though they might not want to do it because of too many people unemployed?
Okay, it is difficult to be honest, for a Greek to answer this question for one reason. First of all, I don't trust the statistics of the government, what they say about the unemployment. I believe that unemployment is much higher than what they say. Also, you have to keep in mind that in Greece we have the famous black economy that accounts for something like 40-50% of the GDP. So when it comes to statistics and Greece, I don't know, these two things are not, they don't go well together. But I'm thinking that in the next 1 or 2 years, I'm 99% certain that unemployment will rise very much. This is why I'm saying watch out for social unrest, look out for the news, for events developing in Europe, because the same problem with Greece happens also in Spain. Also Spain has very high unemployment, that is near 20%. So, as I said, the whole European South is in a problem, and the reason for this happening was they couldn't compete with the industrial North.
So are they now importing all the same goods? I mean, I assume that they were importing, cars and all sorts of technology, lots of quality goods from Northern Europe. What's the case now?
Sorry, there was a pause in the phone line. Can you please repeat the question?
Oh, I'm sorry. The question is, so I assume that countries like Spain and Greece, Portugal are not importing the same amount of goods from Germany that they were. Is that true or is that untrue?
Yeah. I'll tell you something which is a paradox. After the Maastricht Treaty was signed and we had the common currency, before we get the common currency, most of the countries devalued their currencies before entering the euro. So you would say theoretically that they would have an advantage over Germany, for example.
To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.